Good morning, everyone, and welcome to the monthly economic briefing presented by the Kenan Institute of Private Enterprise at UNC Kenan-Flagler Business School. I'm External Affairs Interim Director Rob Knapp, and it's great to have you with us this morning. Earlier this week, the Fed met. The prediction was that they would not move interest rates, and interest rates did not move. This morning, we have an employment report. The prediction was that growth would be strong, and yeah, it's strong. So it's time to talk about what this all means going forward for that landing we're going to have after our episode with higher interest or with higher inflation recently. How has the Fed done and what's it going to do next? Answering all of this for us in the next 30 minutes will be our senior faculty fellow, Christian Lundblad, who's going to be on in a moment to talk about all of this and more. He's going to give a presentation of about 15 to 20 minutes. Then we're going to take your questions. You can do that, submit your questions at any time by using the Q&A function at the bottom of your screen. If you're a member of the press, please include your title and your organization when you submit your question, and we'll know to put you at the front of the line. Please know that you can put those questions in anytime you want during the presentation or the briefing. If you are with us by phone today, you can still submit a question. You can email it to me at rob_knapp@kenan-flagler.unc.edu. We're going to try to answer all the questions we get. We have 30 minutes, maybe a little bit more. So we'll do our best on that. If you do get questions to us at the very end of the briefing, it's possible we won't get to them. So just a warning there. All right. That's the intro. We're on to the fun stuff now. Let me go ahead and introduce our senior faculty fellow, Christian Lundblad. Let me also tell you the things he does at UNC Kenan-Flagler Business School, because it's a lot. He is the Richard Dick Levin Distinguished Professor of Finance and Senior Associate Dean for Faculty and Research. Christian, good morning. Good to have you with us.
Good morning, Rob. Thanks for having me. Let me share my screen here a little. Hi, everyone. So my summary word for this morning is wow, right? Like this was a pretty big shock in the positive direction for the labor market, although that does create some interesting challenges for us. So we had well above expectations in terms of the change in the number of jobs created. That includes a significant revision from December. And I'll talk a little bit more about that in a moment, but some of the other highlights, wages accelerated faster than were anticipated, and the unemployment rate held firm where there was going to be an expectation of sort of a modest tick up and maybe the beginnings of a softening that people have been kind of looking for in a way. So so one caveat I want to offer here, and again, the word of the day unambiguously is wow. I don't want to take away from that in any way. But the one caveat I would offer is this is sort of revision time to some of these numbers. So I anticipate, and meaning methodological revision, to be very clear. So I anticipate over, the next few days and weeks or so, there will be some digging in and trying to understand if there were any sort of changes here that were associated with that. But even if there's some, moderation that comes with, with that endeavor, it is still nonetheless the case that these are remarkably strong numbers, and they have significant implications for our understanding of where the economy is, the labor market in particular, and significant implications, as I'll conclude today, on what that must mean for the trajectory of the Federal Reserve going forward. And that ultimately is, a big part of the question marks right now. So here's our mainline unemployment, our employment production, the number of jobs that were created, well over 300,000. That was above the entire range of analyst forecasts that are presented on on the Bloomberg portal. So the expectation there was 185. We so thoroughly outblew that. That was well above what everybody was thinking, and so too did we have a significant revision on the previous month's quarters. And so collectively, we're talking about a significant categorical increase in our understanding of the number of jobs that were created over the last few months. Secondly, this was really broad-based, actually. So, other than really one industry in mining and lodging, this was pretty dispersed, concentrated, I would say, a bit more in retail. So the health of the U.S. consumer is still there. And then the big one was healthcare. There's still a lot of job creation going on over there, but this was a pretty broad-based growth. And so this isn't, unique to any one industry or any one sector. And again, it just speaks to the resiliency of the United States labor market. Pretty stunning, I would say, when you kind of put all of that in context. What else? Well, the unemployment rate was expected to tick up modestly. Again, kind of this understanding that the softening must be coming at some point as a result of, a long business cycle, the Federal Reserve's aggressive actions over the last, year and a half plus. And instead, the unemployment rate stayed flat, 3.7%. And if you look at the picture here, it really is hovering at near record lows for a unprecedentedly prolonged nature. I mean, we had an unemployment rate that was down near this number, prior to COVID, but that was kind of the end of a long trajectory, and then COVID kind of blew everything up. But we're sitting here for a long, long time. So this just stands very, very unusual. Other measures of unemployment, like underemployment, ticked up very slightly relative to the previous month, but again, kind of, reflecting this general degree of kind of flatness or unchangedness, if you want to use that kind of coarse language. So this is not any place where we're seeing anything in the form of softening at all. And I would say one, I don't even know if it's the right word, soft spot, or maybe something that is a little bit inconsistent with the nature of the rest of this report, is the labor force participation. So that's what's provided here in blue. So that's the full civilian labor force participation rate. And then, the prime-aged workers are provided here in orange. And so this is sort of the fraction of the relevant populations that are engaged or actively looking for work. And that was expected to tick up slightly this month among, economists forecasting, and instead the actual number was flat. So we really aren't sort of seeing a big difference in drawing people into the labor force. But there are some important subtleties here. I mean, again, while this remains below pre-COVID levels, that's what you can see in the blue over there. We've been sort of grinding our way back to labor force engagement, ever since the disruption. There are very sort of divergent, and we've talked about these a number of times here at the Institute. There are a number of divergent stories. One is, the prime working age population, that's in the orange, that's completely recovered relative to COVID, and indeed has more than recovered. And so that portion of our labor force is sort of back in play. But older workers, then sort of the residual here, or the part that you're not seeing, they just haven't re-engaged. That participation rate fell and has been largely unchanged. And so there are some, dispersed narratives here, or some bifurcation, if you will. And so I just want everyone to appreciate that. But that's really the only part of the report here that, doesn't show just, wow. I mean, wow, for lack of a better word. Here's the one I really want you to scrutinize. This is the one I've been thinking a lot about. I've been trying to understand the extent to which wage acceleration then is creating challenges perhaps for firms, and then a pass-through effect that is at least engendering a component of the price dynamics, the overall consumption, sort of consumer price indices that we're seeing, or other inflation indices. And so wages actually accelerated significantly in January in a way that was well out of line with what was anticipated. So 0.6% on a monthly basis, and 4.5% year over year, well above what economists were expecting. That's in the blue over here. And so this is a big upward shock. So it's not only we created a lot of jobs, but the amount of compensation that's associated with that is significantly elevated. And so again, this really begs this question: is this feeding into broader inflation? Is it eating away at the profits of firms as they are struggling to absorb these elevated labor costs? And then do they have but no choice to try to find, if they can, compelling ways to pass that on to their customers? Or is this reflecting something more Goldilocks, and indeed a fundamental question about the productivity of the American worker? The answer to this question is critical, but for sure, when the ambiguity and uncertainty, and I'll talk about this more in a moment, with respect to where we are on the inflation dynamic remains, and the Federal Reserve struggling to try to really ascertain indeed where we are, and that was reflected in Wednesday's decision and the ensuing press conference by Powell. This certainly begs the question of whether, the Fed ought to be, again, continuing to stay on pause as we try to really figure out what's the underlying driver of this thing. So at just a simple level, this is a big number and well above where we thought, and it is not suggesting that there's some moderation here in wages that might be associated with a moderation, in prices as well. And again, the resilience of the labor market is in the backdrop of some data that did not come out this morning, but we saw it relatively recently. And that's the health of the American economy more broadly defined. So if we think about GDP growth at the aggregate as sort of the ultimate arbiter of economic activity, that surprised on the upside significantly. I mean, the fourth quarter number that we saw was sort of well above where we thought it was going to be. The overall, annualized growth rate for the entire year of 2023 was 2.5%, and that continued to surprise throughout the year. And a big part of that is the blue. So that's the fraction of that growth rate from kind of the last calendar year that's associated with household consumption activity. And again, just like the labor market maintains some degree of resiliency, so too does the household consumer. Where is that money coming from? Elevated wages to some degree, fiscal largesse to another degree, credit card debt perhaps. I mean, sorting all of that out is part of the understanding here. But nevertheless, the household consumer is indeed remarkably resilient. And the questions then beg, will this strength continue going forward? And will the sort of wage acceleration that we saw, as a testament just a moment ago in the slides, sort of a suggestion of exactly that. Going forward, what do we expect? Well, there is some anticipation of a moderation of the United States GDP. The IMF, came out with their World Economic Outlook, just a little bit earlier this week. They were looking for some moderation getting into this calendar year. Generally, economists are looking for something a bit below what we saw last calendar year, but nothing dire. But again, even there, like the GDP nowcasting exercises that are engaged, so the Bank of Atlanta Fed has one, that's looking for a pretty good first quarter, actually. And the numbers we just got this morning are only going to accelerate that, because that the data that's reflected over there in their nowcasting, hasn't incorporated this just yet. So there's a lot of ambiguity, right? There just is. And the health of the consumer is a big part of that. And so if we look at the measures, survey-based measures of the sentiment of consumers, we see that these are holding up reasonably well. So the blue is the Conference Board's Consumer Confidence Index. The orange is the University of Michigan's Consumer Sentiment. Sort of above zero, below zero, kind of gives you a kind of normalized sense of the extent to which, the consumer has some degree of optimism or otherwise. You do see somewhat different stories here across these two indicators, which is interesting. You don't see that throughout its history. And that's, maybe a testament to how things are measured in a post-COVID world are somewhat complicated. But in either case, you can see some upward ticks here in both of these. So the U.S. consumer is hanging in there. And just as the labor market continues to show some, as I said, remarkable degrees of resilience, and this morning's indicators are nothing but a further testament to exactly that. So given all of this, in a way, the question of the day then is where does inflation fit into this picture? The reality is we have made some remarkable progress on inflation, wage growth like today notwithstanding. And so here are a host of different measures. And I think it's important to always look right now at a host of different measures, given the challenges of post-COVID and all kinds of weird price disruptions and the like. And so these are different indicators associated with personal consumption expenditures on growth rates, annualized growth rates in the headline number, the core number, other things which are designed to exclude housing, for example, because of all of the peculiarities of that component, all the way to some measures at the bottom that are designed to sort of remove some of the most volatile pieces. And if you sort of look across the table, what you're seeing is, inflation is starting to move in that direction. Now, the picture is not unambiguous. Measurement matters here. There's some degrees of variation over here. And so the question everyone is asking is, are we going to get some kind of Goldilocks soft landing? Like, can we continue to have a resilient labor market, a GDP growth that's got is reflecting a healthy, household degree of household consumption, and an inflation rate that continues to sort of mark down, And I don't know the answer to that. I don't think anybody does. And there's a collection of indicators that anyone can point to on either side of that, what has become reasonably vehement debate between team transitory, as it were, and team persistent. I've always put myself a little bit more in the concerns about persistent inflation, I'll be honest. And that's why I say here in the slide, I think we do have to be particularly worried about the challenge of what's called the last mile. So getting down, as we had an alleviation of some of the crazy supply chain disruptions that were there, that's an easier way to moderate inflation. But worrying about that last bit, so we can really get down into inflation rates that are well closer to what the Federal Reserve would like to see, may be harder because it's more deeply rooted in some of those kinds of tensions that I described before, where wage acceleration is putting pressure on firms to do things with their product markets and so on and so forth. But this is really it. Like, in a way, we've made progress. And if you sort of take, any one of these measures and sort of look at them through time, we're well away from where we were, in the sort of weirdness of 2021, 2022, when we had, the hangover of supply chain disruptions. We had, concerns coming from, geopolitical conflict and energy costs and the like. But we're maybe not quite there yet. And so again, I put back in bold here the last mile. And that's really the question then, which sort of asks, how quickly should we be moving in terms of the Federal Reserve's roadmap? So let me talk for a moment about that, and then I'll be happy to take some questions. So here's the Fed's policy rate, right? After a slow start, the Fed engaged in an unprecedented degree, almost, certainly in recent history, of a sharp response to inflation. And we're sort of on pause. And we saw that in Wednesday's announcement. But the Federal Reserve's meeting this week suggested we might be here for a little while longer. Indeed, the language change was a bit more neutral, but Powell's press conference was perhaps remarkably clear in terms of maybe not seeing something in the next meeting in March. And so kind of what's the roadmap going forward? So here's where Fed funds futures contracts are. This is the market's assessment of where things might be going. And this actually reflects what's happened this morning since the labor market report. And so again, right now we sit at 5.25 to 5.5%. And for the March meeting, what do market participants think we're going to see? And the dark blue over here is sort of a probability based on the pricing in that market, how that market is priced. A probability of what the Fed is going to do in March. The dark blue is today, right now, post-labor report. The slightly less dark blue to the right of it is where we were yesterday. And then you can see where we were a week ago and where we were a month ago. And you can see what's happened over the last month, and especially this morning, is sort of a firming up of the notion that we may be sitting right where we are, 70, 80% essentially probability. And this is sort of backed off pretty significantly, especially this morning after the labor report. That having been said, look at the same figure for December's meeting. So where are we going to be by the end of this calendar year? Again, 5.25% to 5.5% is the bucket in which we reside at present. And the market is sort of looking for, 5 to 7 cuts. Like the distribution has shifted significantly to the left in terms of imagining a much lower interest rate by the end of the year. And so is this a soft landing where the Fed can kind of take off, or what would it take to actually imagine, a 1.5%, 2% almost cuts in the interest rate environment that might be associated with an outright recession or something breaking? And so one final way in which to sort of think about this would be to imagine kind of where should we be, commensurate with the underlying economics that we're observing. And so the red here is the actual Fed funds rate, and the blue is an estimate of perhaps where it ought to have been with a standard kind of off-the-shelf model, which we call the Taylor rule, a kind of reaction function. How does the Fed normally respond to the traditional stimuli to which it is tasked with responding? And we're seeing some disconnect here. And so I want to finish with this point, and then I'll take questions. So the Fed funds the Fed funds forecast here from the FOMC is in the darker color. That's signaling from the Fed itself. I'll show you that more concretely here in my last slide in just a moment. So the Fed is signaling a modest degree of rate cutting over the calendar year. The economic environment is going to dictate that. And so if we indeed get something like a mild recession in green, that means that I'm going to imagine a slower economic environment, maybe some negative GDP growth, mild. We might actually then see this kind of decline. But if we see strong growth and continued inflation, you could imagine a sort of economic call for the rate environment to continue to increase. Like, there's just a lot of ambiguity here. That's what I want you to see. And the market is expecting one thing, which I think is rather extreme, relative to the degree of ambiguity over here, as well as what the Fed itself is signaling. So let me finish with that, and then I'll take some questions. So here is the infamous Fed dot plot. So this is what the Fed is signaling to us as market participants and economists and academics and the like. This is slightly dated. It comes from December. We won't get an update on this until the next meeting in March. But nevertheless, I would like you to just zero in, for the sake of this argument, on 2024. This is the collection of FOMC members, and each dot there represents one of the decision makers. And this is what they are signaling to us about the roadmap for their own policy by the end of this calendar year. And so the lighter kind of Carolina blue there is the median, and then you can see some range of disagreement. Some of the members are a bit more hawkish and imagining not much in the additional way of cuts. Some are more aggressive down at the bottom, one in particular that's imagining a more aggressive degree of cuts. And what you can't really see over here, but overlaid, is a red dot. And that red dot is what the market is expecting. And the red dot is actually down by the most dovish, the most aggressive rate cutter of these committee members. And so the committee is in one space, and the market is expecting something far more aggressive than what the committee is signaling, which I'm not sure we're going to get. Someone's going to be right. If the last mile proves challenging, as I fear, and getting the inflation rate down proves challenging, then the market may be surprised and the Fed may be more steadfast in holding rates than they expect. And indeed, that very much is consistent with the kind of signaling that Powell offered on Wednesday. I'll stop there and take questions.
Thank you very much, Christian. Every once in a while, we have one of these where the number we get looks nothing like the number people expected. So that always requires a bit of agility on the part of the presenter, and you did a great job with that. Thank you. Bonus points for the Carolina Blue reference, since we have a UNC Duke game coming up this weekend. Excellent placement there. We have lots of questions from folks, so we'll get started. Matt Boyle from Bloomberg. This is something you addressed. He says the one number that's downbeat here is the labor force participation rate failing to rise. Job market's hot, doesn't seem to be pulling people into the sidelines. You talked a little bit about how the prime age has recovered, that there's a lot of ambiguity here. Anything else that you might want to address in terms of his question?
Yeah, I think I touched on it a little bit, which is there is a bit of a bifurcation over here. And so looking at broadly based participation mixes different age groups. And I think, Matt, the reality is there's a subset of the American population that's gone and it's not coming back. And that is, that's the overhang of COVID. People change decisions about their lives and their priorities. They're not coming back. And then the prime age worker has bounced back and indeed stays, is kind of well above, where we were pre-COVID. And so, again, holistically, this number, didn't show the same kind of action that we saw in other figures that were released this morning. But that one, I think, is mixing a little bit of two narratives, and so I want to highlight that.
Okay, thanks. And Matt followed up a little later, saying this week Powell said he's not sure if working from home has been a big boost to U.S. productivity. Productivity is something we talk and write a lot about at the Institute. What do you think about that?
Well, that's a really hard question, to be honest. Like, first off, measuring productivity is a challenge unto itself. Yeah. Nevertheless, I think it's impossible to imagine that the technological innovations that we're witnessing, and AI is just an example, will not have significant productivity benefits. However, I personally don't think work from home is one of them. I hear from many, this is more anecdotal to be clear, many business leaders that feel that they learned that they could operate in a work from home environment, but there are costs in terms of sort of the accidental innovations. That's a critical ingredient to productivity, as well as culture building, as well as sort of other other things that are a bit mentoring and other sorts of things that are a bit harder to measure. And so I think work from home surprised us in the extent to which we could operate, but I do think there are costs in terms of productivity. And so if we sort of take the collection of technological things that have happened, that one to me, I think, has the risk of costing us in terms of productivity. Not everyone's going to agree with me there, but there are other components of technology that I think are going to fundamentally transform productivity going forward. It's just going to take a little while for us to observe that in the data because of the challenges of measurement.
Okay, so some big movements ahead there, perhaps. Thank you. Here's one that came in by email. The Fed has hiked rates quickly and to a real rate that is much higher than pre-COVID trends. Since household consumption and employment growth have been so resilient, how much does it matter that we had a wow report for the Fed? Even if productivity is high or inflation stays at the current level, doesn't either outcome mean the Fed can't cut rates and maybe even need to hike them?
Well, I mean, so this sort of gets to a little bit of what I was saying. Thank you for that question, which is, in a way, how resilient and robust is this economy? How tight is the labor market? How close are we or beyond full employment? How much are these inflation rates that we're seeing and wage acceleration that we're seeing, inflation rates and the like, associated with additional degrees perhaps of overheating? I personally, again, I want to be very clear. I have been very much worried about persistent inflation. I've been very much worried about the Fed being too quick to walk off of that. And I struggle with some of the language and the political pressure that they're facing, calling rates, astronomically high and using that kind of, language that I think is unproductive. And so I don't know that we're necessarily in a situation in which the interest rate has to be dramatically higher, nominal or real. But I do think, I guess I would say we're in an improving environment where unambiguously the inflation rate has come down. And so kind of keeping nominal and real rates where we are, not real rates will moderate slightly as inflation falls, I think is probably the right call, particularly given the overarching story really is ambiguity and uncertainty. It's really hard to figure out what's going on in real time. So I think that would be my policy choice if I were able to do it. And I think it's okay to have an elevated real rate right now, given that we're sort of moving through this process and there's a lot of uncertainty about the trajectory.
Okay. Another question says professional and business services added 74,000 jobs, higher than the average increase of 14,000 in 2023. How do we square this with increased layoff announcements among tech companies?
Yeah, we've had an interesting degree of these sorts of questions. Thank you for asking that one. The reality is, it's not a labor market, it's labor markets, plural. And while there are demands for certain skills and certain jobs, there are, shifting demands for others. And so we are seeing some interesting reshuffling in the midst of all of this. And so there are some pretty high profile announcements we've seen, financial services, tech over here, and certainly, and regional differences as well within the United States, to be honest. But so I think that's a reflection of a shift in where firms would like to allocate their resources for growth. And so some of that may be associated with top line pressure. Some of that is associated with just simply interesting growth opportunities, a little bit of both. But I will say this particular report surprised me in that, with only perhaps one exception, professional business services were not alone. This was a broad-based degree of job acceleration across most sectors. So it's sort of a general macro trend in a way that's sort of in the background of all that shuffling I just described.
Okay. Thank you very much. Okay, we're going to try and sneak a couple more in. It's
Sure.
9:30, so if people out there, if you've got a 9:30 on your calendar, you're just going to have to make your decision now. But we're going to have a couple more for you here. This one from Barbara Senich. Do you think the Fed would ever throw in the towel, so to speak, and accept a somewhat higher long-term inflation rate goal, move the goalpost basically? And what would the implications of that be?
That's an interesting question, and it has been pondered by some, for sure. And so, what's magical about a 2% target? Nothing. I mean, it's an arbitrary choice. It's low but positive. That's sort of the idea in a way. Um, you know, inflation costs are real, and so that and higher levels of inflation breed higher levels of expected inflation, and that engenders costs too. And particularly in an environment like ours, where we have been remarkably cavalier. I always come back to this, and somehow, Rob, you get me back to this. We've been remarkably cavalier in not talking about our level of indebtedness in this country. And so we are remarkably indebted, and we're going to have to continue to go back to the capital market over and over and over again as a federal government. And so elevated rates of inflation rooted and built in then affect long run borrowing costs. So that's not something I'd like to see. It could be the case that the underlying economics are such that, going forward, maybe if we have a greater degree of weight as a society on supply chain resilience and less degrees of globalization than we have in the past, that's costlier, just as a baseline, right? Just as an example. And so maybe then you just have a higher level of inflation that has to absorb that kind of cost, and you make a trade-off as a society between sort of resilience and cost. I'm as a caveat, I'm uncomfortable with going in that direction, but it is nevertheless a possibility where you could have elevated inflation. And if that's the world, at some point the Fed would have to adjust to it. Throw in the towel maybe is a strong word, but they'd have to adjust to it. But I think my personal view is, for the time being, right now, the Federal Reserve should demonstrate unambiguously that it is an inflation fighter. Its single most valuable asset is its credibility, and an erosion of that is costly for all of us.
Okay. And I'm not doing that on purpose. I'm not leading us back to the debt. I'm not trying to trigger you on the debt question every time.
Yes, I'm easily triggered on that.
And we go where the questions lead us, right? One more and we'll be done. This one is from Greg Brown. If it's the Greg Brown I think it is, it's somebody who has sat in the hot seat as you are now. Mm-hmm. So how much of a wild card is the Middle East conflict? I'm thinking an energy price shock in particular.
Yeah, I mean, I think, we ought to put a serious weight on that risk. And so, what does that do? At a minimum, it creates, an upward pressure on energy cost. I think it's hard for us to absorb that right now, given that, we still have a very significant, geopolitical conflict in the Ukraine, and that's associated with energy cost elevation. And so it's a different dynamic from the one I've been talking about, because it's sort of an external supply shock that kind of comes in and hits. But we've lived with those in the past, in the 70s and early 80s, and they were particularly consequential. And so I think, at a minimum, the first order effect there is, the risk of, engendering some elevated energy costs that would just put some headwinds in the Fed getting where it wants to go. And then, of course, there's all kinds of other auxiliary concerns, not the least of which is, the loss of life and the challenge of just more human suffering.
Yeah, absolutely. All right, we are going to call it a day. Thank you very much, Christian Lundblad. You took on all comers today, covered a lot of subjects in 30 minutes. So very much appreciated as always.
Yeah, thanks everyone.
And thanks to everybody. I always thank people for their questions, but this seemed to be an especially strong day. Folks hit a lot of the high points and gave Christian an opportunity to talk about them some more. So we appreciate you all and your questions. Thanks for staying with us and doing that. So everyone in the media, if you'd like to continue the conversation, we'd love to do that. Please reach out to me if you'd like to talk to Professor Lundblad. or any of our other experts about any of the subjects we cover here at the Institute, you can email me at rob_nap@kenan-flagler.unc.edu. For everyone that's watching right now, we'd love to have you check our website out, kenaninstitute.unc.edu. We have some new insights and commentaries that are either just up or going up soon, including one on AI and small business that I think you might be interested in. So we hope we'll see you on the site soon. So that is it for today. We appreciate you being here this time. Next month, it will be one of those times when we're not on the first Friday of the month. I believe we're on March 8th next month. So we hope you'll be with us then. But until then, thanks again and have a great Friday.